Taxes, the bane of our lives. Federal income tax, state income tax, property taxes, sales tax, use tax, transfer tax. If the government can find a name for it, they will try to vote it in. However, without taxes, we would be unable to fund our infrastructure. Property taxes, in particular, functions as a watershed for funds that make our community a viable one. This session is not going to be about that one-time tax on the transfer of real property, the transfer tax, nor is this going to be about the sales taxes on the purchase of personal goods. This is Juliana too, and what I'm going to discuss today are the yearly property taxes collected by the state of California, because this is the state that I practice in. After we're done, be sure that you go and check out informational links on the video description below. So let's go forward and meet these taxes face to face. First of all, let's go ahead and go to the disclaimer. The information contained in this video is only intended to provide as a guide in the various California-only transactions to which this information is applicable for. No representation is made as to the legal validity of the information or the adequacy of it in any specific transaction. The information contained should only be used after consultation with legal and financial counsel. The types of taxes. Simply said, there's only two types of reoccurring taxes that we have to deal with. The first are secured real property taxes. This is on real property. The other are unsecured personal property taxes. These are taxes that are levied against anything other than real property. This includes personal property taxes on the business company's fixtures and equipment. It also includes taxes levied on boats and aircraft. These taxes are assessed and paid every year. Now, unsecured secured taxes. Secured taxes are by far the most important and revenue generating taxes. All of our state, county, city infrastructure depends on this revenue. They are assessed on every single piece of privately owned real property in the state of California, no matter its type, its usage, or the location. Government-owned property do not get assessed on it. Each time a property gets transferred, the property could be reassessed. So here's some fun facts about these taxes. First of all, the assessment is based on 1% of the sales price or the current market value, and it can be increased up to a maximum of 2% from the previous year. So no matter if the real property value goes up in leaps and bounds, the assessor can only increase it up to 2% every year from the last year's bill. The tax year, unfortunately, is not chosen to be on a calendar year from January 1 to December 31st. No, because they have to make life harder for the taxpayer and for us escrow officer. The property tax fiscal year is from July 1 of one year and goes through to June 30th of the next year. Now, the regular tax bill is issued every year, once a year, and it can be paid in 2 installments, on November 1 and on February 1. However, if you don't pay by December 10 or by April 10, you will get a penalty. Now, regular tax bills are issued around October every year to the person who owns the property on January 1. That's an important date. Whoever owns the property on January 1 will be assessed that tax bill, and it will be assessed on the value of the property on that date. Added to that, the tax collector also collects the taxes that have been voted in by the city, by the county, the school districts, and the state when they vote in assessments and bonds. For an escrow officer or a lender who wishes to approximate how much the regular taxes are going to be, you're going to need to, besides that 1%, you're going to need to add in 0.25 to 0.5% of the market value in order to get the whole tax bill. So let's say that you've got a purchase price of a new home at $750,000. You've got the 1% plus a 2.5, so 1.25% of the 750,000 is going to be 9,375 a year, or 4,687.50 per installment. So how is it determined? Proposition 13 back in 1978 was passed by the voters, in which the property values were frozen to the 1976 assessed values and only allowed to increase by no more than 2% each year from the previous bill. This applies to all types of properties. However, the bill said that once the property is sold or transferred for value, then the assessor's office will be free to do a reassessment. Now, there are exemptions from this reassessment, especially if it is not transferred for value. Maybe it is a gift from family members, or it is something you're putting into your own revocable trust. These exemptions are covered under my video about documentary transfer tax. A link is provided in the video description below. All these exemptions must be clearly stated on the transfer deed as well as on the preliminary change of ownership form that has to be filled out. If you use the property as a principal residence, you get a $7,000 exemption from the top of the assessed value. This claim has to be filed in order for the exemption to apply, and it can be filed only on one piece of property in California at a time. If you own a vacation home, well, I'm sorry, but a vacation home is not considered a principal residence unless you apply for it, you declare for it, and the assessor's office agrees to it. And this is another important fact. If the assessor's office sees that the sales price or the designated value of the property is much less than the comparable current values in the area, they can base their assessments on what they deem is the correct value and not on the value that you put on the transfer deed or the preliminary change of ownership form. Throughout the year, the assessor gets notification of the transfer of ownership, which will then, of course, trigger the reassessment. We advise our clients that it takes about 4 months for the reassessment to be completed and the county tax collector to send out a bill for the reassessments through a supplemental tax bill. We also remind our clients that the supplemental tax bills are in addition to that regular tax bill that was issued out in October. They both have to be paid. Also, if the assessor's office finds out that there are tax assessments that may have escaped their notice, then they are allowed to backtrack. This used to happen a lot in those years when the properties were being flipped very quickly. Every 2 months, the property was being flipped, and the assessors had a very difficult time catching up and reassessing it in a timely manner. So they would do the reassessment and put it on an escape bill in those situations. If you have a new loan and the lender is collecting and paying your property taxes for you, you need to set up an impound account. Now, lenders can collect part of the taxes in advance through the closing, through the escrow, and they will put this amount that they collected in a special account. And every month, the borrower, as they make their monthly mortgage payment, they will also pay partially on the property taxes. and it goes right into this account. When the property taxes become due twice a year, the lender will then make the payment for the borrower. Taxes are always on the list of items that are going to be prorated by the escrow agent. Now, what is proration? The proration is a calculation of how much is paid by each party for their share of the total bill. Unsecured personal property taxes. Unsecured taxes are those that are assessed against movable or personal property and normally applies to the furniture, fixtures, and equipment, or we call it FF&E, that is used in the operation of a business. If you own a business and the cost of the fixtures and equipment exceeds $100,000, then every year you're going to need to declare their values that is determined on January 1 for the year on a business personal property statement form 571L. So by May 7th, you have to declare these taxes so that the next year's amount will be assessed. Otherwise, if you don't declare it, you're going to be penalized. And of course, the assessor will always estimate the tax that you need to pay for you. We talked about escape taxes previously. There are times when the escape property taxes came out after the real property had already been sold and transferred to a new owner. These escape assessments, instead of being put on the real property, because the property, of course, has already changed hands, will then be put on the unsecured tax roll against the previous owner. This unpaid tax will then come up every time that previous owner, that taxpayer's name, is researched in the county index file, especially when he goes to sell another property or another business. These escape taxes will come up. Now, I also mentioned boats and aircrafts. Yes, those boats and aircrafts also has taxes that have to be paid. Manufactured homes and mobile homes are a different altogether set of personal property. We have two types of mobile homes. Type 1 is a mobile home that is already fixed with a foundation that goes into the ground and it is permanent. When that happens, this mobile home is considered a real property and they will be taxed as a real property secure tax that way. The second type are those mobile homes that are not fixed to the ground and can be moved. Then they are treated as an automobile and they are licensed and taxed by the Department of Motor Vehicles. Personal property tax bills comes out once a year also around March 1 and become delinquent if they're not paid by August 31. The tax year is the same as a secured tax year. It's from July 1 to June 30th, but they only have one payment a year. The assessment is the same. It's 1% of the value of the business equipment, plus, of course, any other bond or debt measures that were voted in by the residents. We usually add another 0.1% to that. So, for example, if the business fixtures and equipment is valued at $20,000 a year, multiply that by 1.10, and your unsecured personal property taxes will be $220 per year. Did I happen to mention that the government wants to be sure they get all the taxes that they can? All right, I am going to talk now about the 4 different county agencies that deal with taxes. While most California counties have the same setup, some may incorporate the following 4 departments together or combine them with other departments. The first one that we have is the assessor's office, which assesses and determines the value of the property. Then we've got the auditor controller's office. They receive the assessment information from the assessor's office, and then they apply the correct tax rates to determine the amount of the taxes to be paid. At that time, they will also add in the funds for the local taxing agencies like the cities, the counties, the schools, the special districts, and so forth. Then we've got the treasurer and tax collector. They're the ones who actually issues the tax bills and collects the payments. And finally, we have the reassessment appeals board. When you don't like the assessment on the value of your property, you can always take it to the assessments appeals board. They review the taxpayer's appeal of all these assessments given to the value of the property, and they decide whether it is correct or not. I hope that I was able to effectively talk about this subject of taxes. I know it is a very dry subject, but it is necessary to know something about it, because as long as you own the property, you are going to be affected. Today, I am wearing my Kyoto t-shirt. I took a lovely boat ride on the Hozugawa River when I was in Kyoto, and I was gifted with a t-shirt that you see the front is right here, and the back, if you can see it, says that I am the spirit of this Hozugawa River boat. It was a very lovely trip, and Kyoto is beautiful, historical, and very much worth visiting. There are other articles in the video description below, which links to part of this topic. I hope that the information I provided will be useful to you. Be sure you click like and subscribe. This is Juliana too, and I shall see you in the next video. Thank you for watching.